Okay, so today we're going to be diving into like the world of investing. And not just with anyone. We're talking about Benjamin Graham.
Yeah, he's a legend.
Totally. We're doing a deep dive on his book, The Intelligent Investor.
The Bible of value investing, that's what they call it.
Exactly. What I find so interesting is this book was published way back in 1949,
Yeah.
but it still like resonates with investors today.
And that's what's interesting is that, this book published back then, it still resonates with investors today. It's almost like Graham had this uncanny ability to kind of see through all the noise
Yeah.
and understand these like timeless principles of investing.
It's like, why should we care what somebody from over half a century ago thought about investing,
Yeah,
But then again, maybe that's the point.
right.
Some things are just fundamentally true no matter what decade it is.
Exactly.
Yeah.
That's you hit the nail on the head. See, Graham, he wasn't like obsessed with some magic formula or some get-rich-quick scheme. He was all about understanding the intrinsic value of a business.
Okay.
He argued that that's what truly matters, and that concept is just as relevant today as it was, back then.
So it's less about like trying to time the market perfectly and more about really understanding what you own.
Basically.
Yeah.
And that's where his concept of Mr. Market comes in.
Okay.
Picture this. Mr. Market is like your business partner, right? But he's incredibly moody. Every single day, he offers to either buy you out of your share of business or sell you more of the business.
Okay.
But his prices are all over the place.
Oh, no.
Some days they make sense, other days, well, he seems a bit delusional.
Okay, that's a pretty vivid picture.
Yeah.
So how do we, as investors, then avoid getting caught up in like Mr. Market's emotional roller coaster?
Yeah, that's the million-dollar question. Graham argued that you shouldn't try to outsmart Mr. Market by predicting his every move. Instead, you need to recognize that these price swings, they're actually your opportunity.
Okay.
When Mr. Market is irrationally exuberant, well, maybe it's a good time to take some profits. But when he's overly pessimistic, that's when you might be able to find some real bargains.
It's almost like you can use it to your advantage then.
Exactly.
Turn it around. Kind of reminds me of that famous saying, be fearful when others are greedy and greedy when others are fearful.
Right.
Isn't that a Warren Buffett line?
It is, and it captures Graham's philosophy perfectly. You see, Warren Buffett was actually a student of Graham's at Columbia Business School.
Oh, wow.
And he took those principles to heart.
Yeah.
And built his entire investment strategy around them.
Wow.
Oh.
Okay, so we're not trying to like outguess Mr. Market every second of the day.
Right.
But how do we actually determine what a good deal looks like? How do we make sure we're not just buying a bad business at a discount?
That's where another one of Graham's core principles comes in.
Okay.
Margin of safety.
Margin of safety.
He dedicated a whole chapter to this in The Intelligent Investor.
It sounds like some kind of like financial safety net.
Yeah,
Tell me more.
it is.
Okay.
Think of it this way.
Okay.
You're buying a used car, right?
Right.
You don't just look at the sticker price.
Right.
You check for any hidden problems,
Of course. Yeah.
assess its condition,
Right.
maybe even get an independent mechanic to take a look.
Yeah, you're looking for reasons why that price might be too high.
Exactly.
Okay.
You want a buffer just in case things aren't as they seem.
Right.
That's a margin of safety in a nutshell.
Okay.
You're not just buying a stock at a discount. You're buying a piece of a business at a price significantly lower than its intrinsic value, what it's actually worth.
So how do we even begin to figure out like what a company's intrinsic value is? That feels kind of complicated.
It can be.
Yeah.
And it's different for every single company and every single industry.
Okay.
But for Graham, it always came back to the fundamentals.
Okay.
You analyze the company's financial statements,
Great.
understand its earnings, its assets, its debts.
Right.
You look at its competitive landscape, its potential for future growth.
So you really have to do your homework.
Yeah.
This isn't just about picking a company with a catchy name.
No, this is about being a smart investor, an intelligent investor.
Okay.
Think of it like being a detective, right?
Okay.
You're looking for clues, you're trying to put a puzzle together using all the information that you can gather.
Okay, I'm starting to get the picture.
Yeah.
But like, wasn't Graham all about sticking to these like rigid rules? Because, I mean, the investing landscape has changed a lot since 1949.
That's what's so fascinating about Graham, is he was a true student of the market.
Okay.
And he understood that flexibility is key.
So he wasn't afraid to adapt his strategies.
Right.
Even bend his own rules sometimes.
Exactly.
Oh, interesting.
Take his investment in Geico, for example.
Okay.
Now, Geico didn't exactly fit his typical investment mold at the time.
Right. The source material mentions that, yeah.
Yeah.
Seems like kind of a curveball for
Yeah, it
him.
was. He usually favored these undervalued, under-the-radar companies,
Right.
but he saw something special in Geico's business model and its potential for growth.
Okay.
It was a classic case of recognizing a fantastic opportunity, even if it meant straying just a little bit from his typical approach.
So it's he had this underlying framework, right?
Right.
But he wasn't afraid to deviate from it when he saw something that he really thought was exceptional, you know.
Yeah, yeah.
But then that kind of begs the question, how do we know when to stick to those core principles and when to maybe adapt?
Right.
It feels like a tough balance to strike, especially in today's market.
It is a tough balance, and there's no easy answer. But I think Graham's approach with Geico offers a valuable lesson. He was constantly learning, evolving his strategies based on what he observed in the market.
So it's less about following a rigid set of rules and more about being adaptable,
Right.
being a student of the market, like you were saying. But what would that even look like for investors today?
Right.
I mean, the investing landscape has changed so much since Graham's time.
It really has. I mean, we've got these sophisticated algorithms now.
Right.
High-frequency trading,
Yeah.
the rise of these index funds and ETFs that Graham never even had to deal with.
Right. It feels like those things have almost leveled the playing field a little bit.
Yeah.
Made it harder for individual investors to really find an edge. So what would Graham do? Right.
Yeah.
If he were managing money today, would he even bother with individual stock picking at all anymore?
It's a fascinating question. Knowing Graham, I think he would be so fascinated by all this new technology and how it's changed the game.
Right.
But I think he would still be looking for those areas where he could apply his core principles of value investing,
Okay.
especially in areas that are maybe a little bit less crowded with all these algorithms.
Our source material mentions a few, like specific niches, things like microcaps, merger arbitrage, community banks, even bankruptcies.
Exactly.
It almost feels like going back in time a little bit.
It's like going back to a simpler time, right? When you had to really understand the business.
Right.
These are areas that require very specialized knowledge,
Right.
a long-term perspective that a lot of these high-frequency traders, they just don't have. So it's about finding those inefficient corners of the market where your human intelligence, your patience, your in-depth research can still give you an edge.
So while a large part of the market might be more efficiently priced now, thanks to all this technology, there's still these opportunities for the intelligent investor.
Absolutely.
To outperform, it's just you might have to look a little harder, dive a little deeper into these niche areas.
I think that's such a powerful lesson from Graham, and it's perhaps even more relevant today than ever before. It's not about following the herd or chasing the latest trend. It's about understanding your own circle of competence, doing your homework, and just being patient.
This has been a really interesting, eye-opening deep dive on the intelligent investor. Graham's ideas clearly just as relevant today as they were decades ago.
Investing is as much about temperament as it is about IQ, right?
Yeah.
It's about controlling your emotions, thinking independently, focusing on the long term.
So as we navigate this very complex world of investing, let's remember the wisdom of Benjamin Graham. Think like an owner, be wary of Mr. Market's mood swings, and always look for that margin of safety.
Don't be afraid to explore those niche areas of the market where you can really differentiate yourself and potentially find those hidden gems. Happy investing, everyone.